All right, hello and welcome to First Bank's Center for Family-Owned Businesses webinar series. I'm Mike Vanderveld and I'll be your facilitator. Today, we'll explore the 2021 market outlook. Just a quick reminder, the lines are muted, but at any time, please send us your questions through the webinar tool. At this time, I'm going to pass it over to the host of our program, Mr. Joe Ambrose. Joe, take it away.
Thanks, Mike. Good day to everyone and welcome. I'm Joe Ambrose, Executive Director of the First Bank Center for Family-Owned Businesses. Through the center, First Bank takes a holistic view of family-owned enterprises and delivers services to them beyond traditional banking products. These services are centered on insight and advice that address the family component of family-owned businesses. This presentation today is our 13th annual First Bank Market Outlook featuring David Presson, our Director of Investment Services. Just think back over all that has happened in the past 13 years and the impact on the markets. Recession, recovery, growth, pandemic, politics. David has weathered these storms, which gives him a unique perspective on their impact on the markets. He has invited Apollo Lupescu from Dimensional Fund Advisors to join him today, and I will let David formally introduce Apollo. And now, without further ado, David Presson.
All right, thanks, Joe, and hello, everyone. And as Joe mentioned, this is our 13th year of doing this event, and the first time we've had to do it virtually. So though I can't see everyone out there today, I'm sure there's lots of familiar faces. I wish I could see everyone in person, but that's the environment that we're in today. But hey, the upside here for those of us in the St. Louis area is we don't have to get up early now on a cold January morning to drive somewhere. And because it is virtual, we're able to open this up to a much wider audience. As a result, this is our biggest turnout yet with over 200 people signed up. So looking at last year, it was probably the most challenging year yet I've ever faced in my 30 plus years in the investment business. We went from the dark days of March, April, when we really weren't sure what was happening and what the future held for us as we scrambled to find adequate supplies for our household. And you know what I'm talking about. To worries about the election, social unrest, and watching as the stock market made one of its biggest comebacks in history. And of course, worrying about our own health and the health of family and friends. It was some year, I'm sure we're all glad it's behind us as we now look ahead. For today's event, we're going to do things a little differently besides just being virtual. First, as usual, I'm going to give a quick recap of last year, but then we're going to go to a town hall type format as our guest speaker and I will address some of the main concerns facing investors today, including taking some questions from our virtual audience. So let's get started. So as I like to do every year, we're going to review and maybe even make fun of some of what the experts, so-called experts, were saying last year, and give a reminder that you can't always believe what you see or hear in the media or see on the internet. And I promise not to use the phrase fake news. So this slide that we have up now, remember, as I bring up these quotes, that the stock market here in the U.S. bottomed on March 23rd. On this slide, I'll show the date of the quote, as well as what the S&P 500 has done since the day of the quote through January 14th when I put these slides together. So first, on March 4th, David Stockman, former budget director under Reagan, said, no, we're not going to have a V-shaped recovery. It's going to be more of an L-shaped bottom. Remember that V shape. Next, Nouriel Roubini, one day after the market bottom, famous economist, said we're facing a depression worse than the Great Depression of the 1930s. Market up 57% since he said that. 2 days after the market bottom, Peter Schiff, global strategist for Euro Pacific, said investors and retirees will be ravaged. Yet the market went up 56% since he said that. March 26th, 3 days after the market bottom, John Hussman, famous mutual fund manager, said we're going to lose another 2/3 of our value. And we're up a mere 46% since he said that. Then about a week after the market bottom, on March 31st, Jeff Gundlach, famous bond manager, said the previous lows will be retested. Yet we're up about 49% since he said that. And then finally, on April 1st, George Soros, who I don't know exactly how to describe him, let's just say he's a famous investor, said we're going to be in the worst bear market in my lifetime. And he's had a pretty long lifetime. He's lived 90 years now, as he was born in 1930. So Mikey, we can go to the next slide. So if you look at the shape of what the S&P 500 did last year, this looks more like a V-shaped recovery, not the L-shaped bottom that David Stockman promised us. So we went from record highs in February with the quickest decline ever from record highs to a bear market in March as news of the pandemic started to spread. Yet then we had one of the quickest recoveries ever in the history of the stock market and then finished the year at a record high. We can go to the next slide. And here's what all the major asset classes did last year. All in all, not a bad year. U.S. stocks were up almost 21%. Emerging markets up a little over 18%. International developed markets, which is mostly Europe, Japan, and Australia, was up about 7.5%. On the bond side, the U.S. bond market up 7.5%. International bonds up almost 4%. The only area that was down was real estate, down roughly 9%. As you know, the work from home and lockdowns hit that segment the hardest. Yet real estate, though it was down 9% last year, if you go back to 2001, it's been up almost 10% annualized, a little better than the U.S. stock market. And let's go to the next slide. So looking around the world, while the U.S. did pretty well, it was only the 9th best performing market in the world last year, with Korea actually leading the way, up 46%. And overall, of the 50 countries that we track on this chart, roughly half were up for the year. And we'll touch more on international markets here during the Q&A. We could go to the next slide. To paraphrase Charles Dickens, it was the worst of times, it was the best of times. It was really a tale of two markets last year. It was quite the contrast up until March 23rd when the market bottomed, and then what happened afterwards. On March 23rd, the U.S. stock market was down about 30%. Yet then we recovered almost 70% through the end of the year, setting a record for having the steepest inter-year decline with a recovery that finished in positive territory. In fact, the 50-day period after March 23rd was the best 50-day period ever in the history of the U.S. stock market. If you look at U.S. stocks, on March 23rd, they were down roughly 40%, and then they recovered up almost 70% for the rest of the year. Looking at U.S. small cap stocks, they were down about 40% through March 23rd, and then up almost 100% through the end of the year. Similar story for international small cap, down about 38% and then recovered 83%. Even real estate, which was still down for the year, recovered up almost 53% from the March 23rd lows. Every single major asset category on this chart was up after March 23rd, kind of contrasting what some of the so-called experts were saying in mid-March. We could go to the next slide, please. And then looking back over history, in fact, now the S&P 500 has been up 16 out of the last 18 years, and going back to 1928, the U.S. stock market has been up roughly 70% of the time in any given calendar year. Pretty good odds. Now let's go to the next slide. We're going to quickly now turn to interest rates. So looking around the world, as shown by this chart, government bond yields around the world remain pretty low. In fact, in many countries, they are negative. And if you think our yields are low here in the U.S., look at our 10-year yield at 0.92. It's still the best in the world, even though we're not even at 1%. So since this chart was printed at the end of the year, we're up slightly from these numbers, but not a whole lot. And then if you look at the yield curve between the 1 to 5 year period, we're the only country in the world that has positive yields right now. Let's go to the next slide, please. So one benefit of low yields, while it hurts people who live off the income from their bonds, mortgage rates hit historical lows last year, which led to a huge boom in refinancing and housing. So now after this recap of last year, and Mike, you can take the slides off, where do we go from here? Well, we're going to turn over the next part of our we're going to turn to the next part of our program, where we're going to address some of the key challenges facing investors today. For this portion of the program, I'm going to bring in our guest speaker, Apollo, who's a vice president at Dimensional Fund Advisors, one of the largest investment managers in the world, and a fund company that's very highly regarded that we use quite a bit of their funds. Apollo is nationally and internationally recognized speaker who has delivered hundreds of seminars to both investors and financial professionals. Apollo has been with Dimensional now for over 16 years, and prior to that, he taught at the University of California and received his PhD in economics and finance from UC Santa Barbara. Apollo, thanks so much for being here today with us.
Hi, David. It's really a pleasure to be here. Thanks for inviting us, and thanks to everyone for taking the time.
Sure. So Apollo, I think finally the elections are over. I think we can finally put that cycle behind us. We only have to wait 2 years for the next cycle, and we had a new president sworn in yesterday. So I got a lot of questions running up through the elections and even so far this year. But how should investors view elections in terms of plotting their investment strategy?
Right. It's a really topical question. As you said, it's the gift that keeps on giving. For the last couple of months, it's been an election season. So I think that the narrative that you hear out there is that the political party in power or the president in power really has a big driver on the economic agenda, which is absolutely true. And somehow, by extension, it reflects on the stock market and the performance of the stock market. And the policies coming out of an administration certainly can impact the stock market. And what I like to do is rather than give you some opinions, I like to look at some numbers and put forth a thesis that's going to overarch sort of the answer that I will give you, which is by and large that politics and elections are a variable when it comes to the stock market and how our investments do. But what we found, it is not the variable. It is not the primary variable that drives how the market does. And I know it's not exactly what you hear out there, because what you hear about taxes might be going up or down. When you hear about regulations and all these, well, certainly this should have an impact on the market. Well, it turns out that it's a little bit more complicated than that. And to illustrate this, just to make it very simple, let's look at how different presidents did when it comes to the returns in the market during their time in office, and to see if there's a pattern that would enable us to see what might come next. So if we go back in my lifetime, I'm born in 1969, I'm 51 years old. And when I was born, President Nixon was in office. And for the 5 years or so that he was in office, the market on average dropped by about 3% per year on average. So the market went down during his time. And afterwards, we had President Nixon coming in with a whopping 20% return during the couple of years or so that he was in the White House. And if you fast forward and look at the average annualized returns per year during a president's time in office, the one thing that jumped at me is that there is no obvious way of saying, there is no clear evidence to suggest that having a Republican or a Democrat is better or worse for the markets. It's just not in the data. And interesting, right now there's such a big discussion around taxes. What could happen to taxes? Well, we've had presidents in the past who have been known for tax cuts, and President Reagan certainly well known for his tax to income rates. But we also know President George W. Bush, well known for not one but two rounds of tax cuts, something specific to investments, and yet the market on average dropped during the 8 years that he was in office. So it's not really obvious that having a president who is either cutting taxes that would necessarily do better for the market, but even a president that's known for increasing taxes to some degree doesn't mean that it was a disaster for the market. And it's so interesting, because we look at President Obama, known for Obamacare and helping people with health care, and that was one of the main priorities, and yet the market did remarkably well. So it's not easy to say that one policy will drive the market. The data doesn't seem to suggest that even if we have tax cuts, it doesn't lead necessarily, it's not a guarantee there will be success in the market, but even if we have tax increases, it might not necessarily mean that that would be a disaster for the stock market. But as I said, there are many, many other variables that drive the stock market. We had with President Clinton, we had the tech boom that really didn't have to do much with the White House. Here we had 9/11 and the financial crisis, which again, it's kind of unfair to say, well, the president was at fault for all that. So to me, the main point that I'm trying to make is that when you hear that narrative that tax cuts might be good or bad for the market, it's not really clear at all. And furthermore, we also have right now the Congress, and the Congress is certainly a part of the equation. And in fact, if we go back not to my lifetime, as far as we have data in the stock market, and we overlay that data with the growth of a dollar, the growth of your money in the stock market, overlaid with the party in control of Congress, because Congress has a lot to say when it comes to taxation and spending. It's not really obvious that it's a terrible time for for the market having Republicans or Democrats. In fact, the only discernible trend is that the market do tend to reward long-term investors. And whether we had long stretches here when the Democrats were in control and the market went up, we had Republicans in control and the market went up. But in neither case does it seem that it was a perfectly smooth ride. We had the 73-74 bump here. We had the tech bust with the Republicans. And even when you have mixed, it doesn't necessarily appear that that's better or worse. So it's really not in the data. It's not obvious to suggest that having Republicans or Democrats is better or worse. And the one thing that I would draw attention to is this period of here when there was a significant growth in the market, absolutely significant growth in the market in the 1950s when we did have Democrats. But what's also interesting is that starting in the 1940s all the way in the 50s, the marginal tax rate, how much did you pay if you made $1 over 200,000 back in those days? That marginal tax rate was over 90%. Over 90%. That's how much it is. Today, it's about 37%. Different deductions and all that. But the point is that the tax rates back then were 90+%. Today, we're at 37%. So historically speaking, putting some context, really doesn't seem that right now there's such a big concern that the market participants have when it comes to the tax rates. And by the way, up until 3 years ago, the companies were paying higher taxes, and they were able to figure out how to make money and how to protect it. And as we know, right now, it's pretty interesting because after the two elections in Georgia 2 weeks ago, we know that it's not just the Congress, but also the White House in Democratic control. So this idea of a unified government control, how much does that matter that we had the blue wave and now everything is in control of the Democrats? How much would that be different, let's say, than having Republicans unified control? And we looked at the data, and going back to 1920s, in terms of how many of these 90+ years did the Republicans have control of the White House, the Senate, and the House? Well, it turns out there are 13 of these years when they had control. And what's interesting is that on average, just a simple average, the market went up 14.52% during those 13 years. The question is, did the Democrats also have this unified government control? Which, by the way, doesn't mean that they're all kind of holding hands and singing Kumbaya. It just means that they control these three branches. And it turns out they did have it as well. The government was under Democratic unified control, but not for 13 years. In fact, it was for 34 years, a lot longer, this Democratic unified control. And we wanted to know, well, how much did the returns in the market differ from having Republicans versus Democrats? Because there's a narrative out there that one party might be better or worse for the market. Well, it turns out when we ran the numbers and we ran them over and over, what we found is that the average return per year during these 34 years of Democratic unified control of government was 14.52%. It is identical to the second decimal. That's how little it matters. Markets are not driven by the government, and probably the market drives the government more than the other way around. Markets are driven by companies and the products they make, the services they provide, competition, what's going on in the world, the strategy, how they execute it. Those are the primary drivers of the market, not who's in the White House. You know, Facebook or Google or Apple making money has much more to do with their products, with their strategy, than who's in the White House. And this is what these numbers reflect. It is identical to the second decimal. That's how little it matters. So I really want to stress this, that when you're thinking of what drives the market, are they taxes, are they government policies, it is not that as much as you think. And often, even if you have a government who's really friendly towards a particular industry, that does not necessarily guarantee success. You know, as we know, the last administration really had a priority towards steel and fossil fuels. You know, how did that work out? Well, it turns out that you know, at some point they even imposed tariffs. And what you saw is that when the tariffs were imposed, after that there was a downward trend, pretty significant downward trend in the value of U.S. steel, which carries the name of the industry. So even if you have the administration with policies, that does not necessarily mean that you'll be successful or not be successful. It's a lot more complicated. The market dynamics are more complicated. So please don't be either excited or anxious if you hear that government policies in a certain direction for a certain company. It's not the primary driver of the stock market. So it was a long-winded answer, but I thought I would kind of, you know, give us some justice there.
Okay, thanks, Apollo. And this other question that I get asked a lot, Apollo, is we still have very high unemployment. We just got the latest numbers this morning. Many small companies continue to struggle, yet the stock market hit a record high yesterday. Can you kind of explain the disconnect between Wall Street and Main Street?
Yeah, so it's an excellent question, because it's not always obvious. So what we have here are things that are related, the economy and the stock market, but they're not the same. So what I mean by related but not the same, they both have to do with business. And what the economy, when you hear the word how is the economy doing, it's kind of reflecting on what's the economic output, what is the unemployment, the price level, all these things that really have to do with right now, and they impact our paychecks right now. And it's you know, it is true that the economy is about our paychecks right now. Now the stock market, basically what it means to, what it refers to is buying ownership into different companies. And you know, buying ownership into different companies gives us all a stake in capitalism, which I think it's a really great idea. And you become part owner into these companies, and then you are entitled to the benefits of ownership, including partaking in the profits and the earnings that the company makes. Now, the thing is that as opposed to the economy, which reflects on your paycheck right now, the stock market is your paycheck from the future, because you will be getting paid as an owner in this company at times in the future. So not necessarily about right now. And then one thing that kind of came to mind was a gift that my dad gave me when I was in high school, which is a black and white photo lab. And, you know, when I had a camera and I would develop the film, and for the folks who still remember film, this is a bit of an analogy that the economy is pretty much what is going on right now. The economy is a snapshot, is a frame, it's one scene. Whereas the stock market, it's a much longer running movie, because you will have that ownership for many, many, many years down the road. So when you talk about the stock market, it is way down the road, not just right now. And I think the difference that you see is that the market is trying to look not just at 2020, not just at 21, but 22, 23, 24 years and years down the road. How many years? Well, they're companies that have been around for over 100 years. And companies that we all know and are very familiar with. In fact, if you go to the Exxon website right now, there's a PDF that tells you the cash payments that from the profits that Exxon has been paying shareholders since 1911. Over 100 years of these profits that they've been paying. So a very long-term that we see in this stock ownership. Because it's forward-looking, quite often these investors, the stock market, it's trying to figure out not just what's going on right now, but what might happen down the road. And as it anticipates these things, then they might price them in before they happen. And what I mean by that, if you go back to 2009, which is the worst year of the economic downturn, what you see is that at the time we had incredibly high unemployment. The economic output was very low. Everything was terrible. So again, it was very similar to what we're seeing right now, terrible economic output. And the question is, how did the market do at such a terrible time? Well, in 2009, the U.S. stock market, represented by the S&P 500, was actually up about 26% that year. 26% in the worst year of the economic downturn. Is it nuts? No, it's exactly what I would expect. Markets saw there's light at the end of the tunnel, so they're pricing that in today before it actually happened. So, if there's a storm, coming to Florida, well, you don't need to wait for the night before. If you know that's coming, you can get out of the way beforehand, and that's what the market's trying to do, is look forward. And that's a really important point to make. So conceptually, there's a difference between the market and the economy. But this pandemic added another layer to this, and it's a very important layer it's really interesting. And the layer is that when we hear that the market is doing well in the pandemic, well, you're saying, well, there's certainly a disconnect there, and this is through the end of September, where the market was up about 6%. So through the end of September, the market's up 6%. With the unemployment that David talked about, and just terrible economic news. And you might wonder, well, how can it possibly be up at a time like this? Well, the way we measure the market is by looking at companies and then assigning a bigger weight, a bigger proportion to the larger ones. And right now, the 5 largest companies in the U.S. stock market amount to about a quarter of the value of all the stocks. So the performance is driven, a quarter of the performance is driven by 5 companies: Apple, Amazon, Microsoft, Google, and Facebook. And if you look over this time frame, when the market was up 6%, on average, these 5 of the largest companies in the U.S. market were up a whopping 40%, a lot more, a crazy increase. Now, is it rational? I'm using every one of these services every day, except Facebook. I'm not really on Facebook as much, or Instagram. But outside of that, I'm pretty much using them every day. And we're talking a couple of days ago with David that it seems like there's an Amazon box showing up every day. And for a couple of days when it didn't show up, the UPS driver knocked on the door and said, "Hey, are you guys okay?" So it is something that we use. We know that they're making money. But what about the rest of the companies? If these are 5 out of the 500, what about the rest of the companies in the S&P 500? And when you average those returns, it turns out that on average, they are down about 5%. Wow. So it's not that the market's doing well as a whole. It's perhaps the way we measure it, because we emphasize in the measurements these very large companies, and they happen to have done incredibly well over this time period. It makes it look like everybody's doing well, where in fact, because they're so large and they've done so well, they have lifted up everybody to make it look like the market's doing well, when in fact, it might not be doing that well. It might just be a handful of these large companies who are benefiting, not nefariously, but because they had the right solution at the right time for what we needed. So again, a long-winded answer, David, but I think it's really important. What we're seeing right now with the disconnect, it's something that we have seen in the past. It has a very rational explanation, but specific to the pandemic is the fact that the way we measure the market is perhaps could be misleading.
All right, thanks, Apollo. And I got 2 boxes this morning from Amazon, so it's about average for us. So let's turn to bonds for a minute, Apollo. In my recap, I talked about how yields are low around the world, but how should investors view bonds now in the context of their portfolio?
Right. No, it's bonds are a big portion of the portfolio, because equity or stock ownership allows you to partake into these profits and you get ownership. So stocks are about ownership. Bonds are about lending. You're lending your money, and there's a contract in place that specifies an interest rate that you'll get for how long you get it, and at the end you get your money back. So there are two different types of investments that absolutely make sense in most portfolios. Not everybody might need stocks or bonds, but that's something that the David and the First Bank team can help you with. But the reality is that bonds in many cases are part of the portfolio. So why would anybody want to use bonds? Bonds don't make as much money as stocks. We know that historically the returns of bonds have been lower. So then why would you want to do bonds? Well, there are 2 or 3 reasons that people want to use bonds. So let me quickly kind of see if the reasons that people hold bonds actually make sense even in this low interest rate environment. What you get is not as much. The first reason people might want to hold bonds is because bonds tend to hold up pretty well when the stock market drops. And if you look at even in this low interest rate environment, as the stock market dropped at the beginning of the year and in the first quarter, and it was down about 20%, what you saw is that the bonds actually held up really nicely. So you had something to cushion the blow from the drop in the market. And that's been historically one of the roles for bonds, is to mitigate market downturns, give you something to hold you up when the stock market's not doing well. So you lost 20% almost in the market. Well, these bonds kind of held you up, and you want to have that stability. So where stocks are more like, if you're sailing and they're the sails, you put up the sails and you go really fast, but there's a lot of bounciness and choppiness. The bonds are more like the ballast. They slow you down, but they give you more stability, particularly when there's a storm out there. And it's not just 2020 when we saw this. In fact, if you go over the past 20 plus years, every single time that the market drops significantly, these bonds tend to hold up really well. So right now, we don't have anything else. Like in the theory books, there's nothing out there that would provide that cushion. It is not gold. It is not Bitcoin. Is not anything else that would provide that stability and what's called negative correlation. When the market's going down, that these bonds can hold up in value. So they are an important piece of the portfolio. And in that respect, they have absolutely done their job this year or last year, and for that reason, I can't think of anything better right now to give you that protection, particularly if you get close to retirement. Particularly if you get close to not having a paycheck from which you can spend on a monthly basis to consume and take care of the food and the housing and everything else. So that's on that note. The bonds have absolutely done their job in 2020, even in this low interest rate environment. Now, the second role is people looking and saying, well, I like to get some yield, which basically says, how much am I making on my money from these bonds? And I'm not getting that much, but I need something for income. And if you need that for income, there are 2 things that I have to say. If the interest rates are low, you might not get paid as much in stocks, but interestingly enough, in bonds, you might not get paid in bonds, but interestingly, those low rates are benefiting stocks because these companies can borrow at low rates, and that is beneficial for their stock price. So, you might not make as much money in bonds, but you make in stocks. So in that respect, perhaps it's a better idea not to just focus on income from bonds, but a total portfolio return, which is something that an advisor, David and the team, can help you kind of figure out how to generate income, not just from one part of the portfolio, but from the entire portfolio. Because when one is not making you as much, perhaps the other one is. And what's interesting is that when you hear bonds are not giving you that much, a lot of times you're referring to the very safe government bonds. So this is just for illustration as of May, not super vastly different today. If you lend your money to the U.S. government for about 10 years, you would get about 0.7% per year. You'd get about 0.7% per year on your money, which doesn't seem like much. The thing is that this is not the only type of bond. If you're not happy with this, Well, there's an Apple bond, and you can get 1.6% on your money, more than twice as much from an Apple bond. So there is a difference between a government and a corporate bond. And if Apple is not enough, well, we know that we'll be wiping our hands for the next 10 years. So you can buy a Clorox bond that once again pays you a little bit more. And if that's not enough for you, well, there is a Starbucks bond. They would like to borrow money from you. And right now they pay, as of May, they would pay you about 2.5% on the same money. And if that's not enough, well, Southwest Airlines, it's a little more risky. It's an airline, but they pay you over 5%. And if you really, really want to go even further, there are others, like a Nordstrom. And Nordstrom pays investors over 8.5% in these bonds interest rates, in the yields. So what's important here is that you need to have an advisor to figure out, for your circumstances, for your needs, how far do you want to go out on the spectrum? Do you want to stay at the very safe government bonds? Do you want to go somewhere in the middle? Do you want to take more risk? But when you hear the interest rates are low, that's typically referring to the very, very low government bonds, not necessarily to every single bond out there. Every bond, depending on who issues it, who borrows money from you, they might have to pay something different. And you have an advisor, they can kind of help you look at the stock portion and what different types of bonds. You might want to have multiple type of bonds in there, but that's the role of the First Bank team and David. And the last thing that I will tell you is something that we do a lot, and we think about bonds not only in the interest rate that you get, but also, what if you don't wait for that bond to get all the way to the maturity meaning the time when you get your money back? What about if you sell it beforehand? Could you sell it, maybe make some money, make a profit, what's called a capital gain, from selling that bond, and you take the money then and you reinvest it into a different bond. So making money on bonds is not just from the interest, but you could sell it beforehand and make some money. And that strategy, we call it variable maturity, and it's certainly it's a very interesting way of looking at bonds as well.
All right, thanks, Apollo. And just as a reminder to everyone on the call, if you want to ask us some questions, go to the question tab on your screen and type it in, and Mike will help to moderate that. So let's turn back to stocks, Apollo. I mean, we've had a historical run-up since the March 23rd low. And again, just yesterday, we hit a record high. Are investors today overly optimistic on stocks?
It's an interesting question, because the way that I look at it is twofold. The first one is that today in the stock market, there's not a consensus. It's not that everybody agrees. And in fact, I would say there's perfect disagreement today in the market whether investors are optimistic or pessimistic. And why is that? Because the reason for that is because when a trade is placed, when I say, I'm pessimistic about the way that the market's going, so I'm going to go ahead and sell. Well, for me to sell, there has to be a buyer on the other side of the trade. So for every seller in the market, there has to be a buyer. For every pessimist, there has to be an optimist. And right now, if the overwhelming feeling of the market, everybody in the market were pessimistic about the future, well, nobody would be willing to buy at these prices. Why would you want to buy this price if you knew it's going to further drop? I'm going to wait to further drop. So in order for a trade to happen, you have to have a buyer and a seller, and they have to have the disagreement. And I think, to me, what's interesting is that right now, the levels of the market are a reflection of both the bears and the bulls, both the optimist and the pessimist. And to me, that's one way to really think about the market. I don't know if the market's too high or too low. I have no idea, because if the market was to change tomorrow, it's not because of something we know today. It's some piece of information, some news that was not known today that shows up tomorrow, and that could be good news or bad news. But whatever is expected is already kind of put in there in the price that both the optimists and the pessimists are putting out there. The second thing that I wanted to kind of point out is that I've had this thought in my head, many times, which is that, maybe there's a time to be invested, and maybe there's an obvious time to just sit on the sidelines. And And I have to tell you, it makes absolute sense as you think about it. The hardest part is actually executing and implementing. If you think of just last year, just let's do a thought experiment for a second. If your fairy grandmother came and told you January 1st, 2020, listen, we'll go through a pandemic. More than 400,000 Americans or so will die from the pandemic. There will be economic shutdowns. There will be multiple waves. There will be, a civil discord in the country. We'll have an incredibly polarized election in 2020. I just want you to be honest with yourself. If you had all these pieces of information and perfect foresight onto what happened in 2020, what would you have done with your money January 1st, 2020? I can tell you right now, if somebody gave me all that piece of information, I would have said, you know what, there's no way I'm going to get close to market. And yet you would have missed, because as David pointed out, the market actually went up 20%. You would have missed a 20% run up. So the thing that makes this implementation really hard is not just knowing it, but the other big one is knowing when to get in and knowing when to get out. That's the hardest part about executing this. Because you have to, if you decide you want to get out of the market, which I have done years and years ago, then at that time when you do this, there's an equally important decision that you have to make at exactly the same time, which is when do you get back in? And that's the problem, because if you don't know, trust me, it is more taxing mentally, just sitting in cash, thinking, when do I get back in? When do I get back in? Particularly as the recovery might be happening. So we saw this exact thing. We saw it happening last year when the market started dropping. What we saw is that the drop in the market was quite significant, as David pointed out, is that we had these negative returns right here in the market. And certainly it was not a good place to be in the market last year. But as you look at what investors did in terms of what they did with their money, it was quite remarkable. As the stock market dropped, driven by these emotions, the behavioral side of investing, what you saw is that as the market went down, these are the returns on the lower side. These are the returns that we saw in the market back in March, February and January. What you see here is what investors did with their money, and this shows you that investors actually start taking money and putting them into these money market funds. And money market funds are an instrument that is really safe. It really is almost like cash. So people, as the market drops, start selling at a low. So the market was up, now all of a sudden is down. And because the fear settles in and then you're afraid, then people sell. And the thing is that when they sold because of this emotion, because of fear, the problem was that as we start running into these great returns that led to the rebound in the market, most of these folks were still in cash and they never recovered. And it's a shame because, they could have been back to where they were. It's just they did not know when to get back in the market. And by the time some of them thought, oh, I'm going to get back in the market, they already missed some great returns. So that's the biggest problem with, is the market too high? Is the market too low? I can give you my opinion. I can give you, I can give you a thought on that. The problem is that nobody can tell you precisely when to get in and then when to get back out.
Yeah, thanks, Apollo. As I try to point out in my slides, if you listen to CNBC in March, you may still be in cash based on what some of those so-called experts were saying back then. So let's turn to international stocks, Apollo. So far, we just talked about the U.S. On the international side, those stocks have trailed the U.S. for the last few years. So how should investors today be thinking about international stocks in the context of the portfolio?
Right. So my first thought is whenever we talk about international stocks, I want to start by conveying that we're not looking at countries. We're not investing in countries as much as we are investing in companies. It's a very different thing. We're not necessarily investing in countries, but companies. And then if you look and you redraw a world map, where you plot the value of all companies that investors can access and buy into in different parts of the world, this is what the map will look like. The U.S. is the largest, and about 54% of the value of all stocks come from the U.S. And there are about 3,000 of these stocks, and they amount to a little over half. But what it means that there are about 9,000 plus other companies in 40 other countries, stock markets, that you can access. And the question is, do you want to limit yourself only to U.S. companies, or does it make sense to explore opportunities? Do companies abroad make money? You know, we have a Ford and GM in the U.S. Should we consider BMW, Germany, and VW from Germany? Should we consider Honda and Toyota in Japan? Should we consider Jaguar and Land Rover in India? All of these are opportunities that investors have. So as much as it makes sense to look at opportunities in the U.S., it also makes sense to look abroad. So conceptually, I think it makes absolute sense. And Warren Buffett recently had a lot of money to deploy, and he was looking in the U.S. where are some good deals, and he actually couldn't find any good deals in the U.S. as much as he found them in Japan. So right now, in terms of valuations, which means how expensive things have gotten, the U.S. market tends to be a lot more expensive today on relative terms to the rest of the world. So as an investor, absolutely, it makes sense. Now, it's also true that we have had a good run in U.S. Relative to the rest of the world. And if you go back to the last decade or so, and this is where people start noticing this, the U.S. was one of the best performing countries in the world. This is the U.S. in yellow here, and it wasn't as good as New Zealand, but it was still a very good return. Now, the thing is that if we just go back one previous decade, because you hear now, why don't we put more money in the U.S.? I can tell you that the decade before, it was exactly the opposite. The U.S. was one of the worst performing countries. So it wasn't not nearly towards the top, it was towards the bottom. And the questions that I would get is, why are we investing in the U.S.? It doesn't seem like it's doing very well. Why not really diversify broadly abroad? So there are times when the U.S. is doing well, and there are times when the U.S. is not doing very well. And in fact, you can go back on different decades, not just the last two, and you say, okay, this is the 2010 to 2020. That's the 10 years that we just went through, and the U.S., which is in this teal color, has done better than international developed in orange. But if you go back to the data, the beginning of being able to measure this, in the 1970s, international stocks did a lot better than the U.S. In the 1980s, it was the same thing. And in the 1990s, the technology stocks really shut the lights out in the U.S., and U.S. did better, pretty much like this time around. But we know what happened afterwards. It was the bit of the hangover and the lost decade, where for 10 years, actually you lost money in the U.S. market. So to me, it absolutely still makes sense. I'm glad that the U.S. is doing well. In fact, I'm glad that I see the seesaw, that sometimes the U.S. is on top, sometimes is not. But I also see that 3 out of the 5 decades, international has done better. We're in a stretch led by technology, like it was in the 90s, and people are really happy to be diversified in the 2000s. So to me, it's absolutely makes sense. It's something that you, in my view, is essential as an investor to consider global opportunities. But the one thing that I would also mention is that advisors have a big role. Because David and the First Bank team, they have a role in deciding how much money do we want to put in the U.S. versus international developed countries, and maybe some money in emerging markets. And that is both science and art. And if you need more, information on that, certainly they're the folks to give you that.
All right, thanks, Apollo. Mike, we've got a few minutes left here until we get to the top of the hour. Are there any questions that have come in that we can address?
Yeah, absolutely. First of all, thank you so much for that great information. And as a reminder, just go ahead and type your question right into the webinar tool, and we'll be able to read that out loud. First question here says, are cruise line stocks a good buy right now?
So
you can probably get a good deal on a cruise, but
I was gonna say, it's probably a ticket is probably more so than this stock. Listen, the thing is that there are two ways to think about investing, and the first way to think about investing is whether or not a stock, a particular company, is a good buy. In our view, the main thing that you want to look for is what is the price that you're paying to own that relative to whatever risk might be out there. Because when you look at cruise lines, they might be very inexpensive, but they might also have a pretty large probability of going bankrupt and being wiped out completely. So what's interesting is that is it a good buy? Well, right now, with all the information that we have, if the price is very, very low, it might reflect a pretty big probability of maybe the company going under. But there's another bigger point that might make sense to address. Whenever we talk about does it make sense to buy a sector or a company, there are two ways to think about investing in the market. And the first way is to try to select individual companies like cruise lines, airlines, bank stocks that have been hammered lately. And it's a good idea to actually look at companies that have not been doing well because their price is lower. So in that respect, I think it makes a lot of sense. And one way to think about investing is to cherry pick a handful of these companies that we think are going to do really, really well, and concentrate, put a lot of money into them, because at that point, if these companies were to fly high, then you can make a lot of money. And that's what we all want. We want to make a lot of money. The thing is that when you concentrate into a handful of these companies, it's possible that they might shoot up in value, but it's also possible that they might go bankrupt. And at that point, you lose everything. So to me, if you were to place these bets, then you are pretty much a bit like a casino player. You place some bets, you can win, or you might not. The alternative to that is that you own these companies, but you might own them as part of a larger group, a much more diversified group of stocks, where not any one of these companies will ever significantly impact your wealth. So you will have the cruise lines and the airlines and the banks and everything out there, but none of them will be into such a significant portion that they would significantly impact your wealth. And the benefit of that is that what you're doing through this very diversified approach is that you shrink the range of what can happen with your money. In other words, it's if you own, like in the First Bank might have thousands of companies around the world. It's unlikely that all of them will go bankrupt at the same time. So you're likely not going to lose all your money in the stock market. It might be a temporary dip, but it's not going to be like going bankrupt. But on the other hand, you're not going to have one high flyer that's going to change your wealth status. So the way that I like to think about it, it's absolutely reasonable to think about companies that are lower in price. Maybe they're a better value to buy. I also want to consider that I don't want to place these concentrated bets. I don't want to be the casino player. I want to be the casino house. And the only way to become the casino house is look at these in a very diversified way. So I'm not a fan of placing individual company or individual sector bets, because I think that's exactly what it is, a bet. And I'd rather kind of not speculate but invest. And the way to do that is to be very broadly diversified.
All right. Thanks so much for that question and that answer. I just want to give you a reminder, if you do submit a question here and we run out of time, we are going to log those. We'll get an answer back to you later on. So don't be afraid to submit those questions. And we do have time here for just a couple of more. Next question says, if someone doesn't know a whole lot about stock markets but wanted to learn more, what books or resources might you recommend to expand their knowledge?
Oh, that's a really good question. So in terms of expanding the knowledge in the stock market, what I found is that a lot of books out there, they do a good job, but I'm not sure they're written for the average person. So it really depends what part of understanding the stock market you're looking to do. I think that if you're trying to just understand the dynamics between what's a stock, what's a bond, how does the market function from an intellectual curiosity perspective, I can certainly follow up with David and give you some suggestions on those books. if you're looking to become somebody who actively participates in the market and buying and selling, and you're looking for a book that would give you that edge, I'm not sure that I have one book, because David went to school for this. I went to school for them. I have a stack of books like this that help me navigate the stock market. But I will also caution you that if you do it with the idea that you're going to do better than the market or somebody else, you have to realize that, as I said, for every buyer there's a seller. So right now, the market is dominated by professionals. So if you're going to try to read a couple of books and say, I'm going to go start trading because that's going to make me money, chances are that the person on the other side of the trade will be a very sophisticated institutional investors with a lot more resources, a lot more acumen. So what I would say is that if you want to do it for the fun of it, I can certainly send you some pieces there, but I would caution, if you try to understand how the market works just intellectually, absolutely, there's some great books out there. If you're trying to do it so you can be competitive, I think that's a lot harder, and you are probably at a disadvantage relative to somebody who pays to get a lot more information, has analysts and computers and data that's really hard to be obtained by a retail investor.
All right, thanks so much. And we do have 4 minutes left. I want to get one more question in, but in case folks have to drop off, allow me just to plug real quick our next 2 sessions coming up. January 28th, the Center for Family-Owned Businesses webinar series is going to have our second webinar in the Women-Owned Business series. And that session is going to focus on wellness and life-work balance and HR trends. And then on February 9th, we'll explore the topic of buy-sell agreements in the family-owned business space as well. So again, look for First Bank emails to sign up for those great sessions. With that said, I do want to squeeze in another question. I'm going to combine a couple here. How do you view alternative currencies such as Bitcoin and others in light of the fact that the dollar is probably going to fall based upon the waterfall of debt that we're bringing on? And then this other question really talked about with the added trillions of dollars in COVID stimulus debt on the economy, what impact does that have as well? So let me throw that your way.
Right. So let me start with the coin, the Bitcoin. Well, as you pointed out, Bitcoin is supposed to be a currency, and what it is, it's an electronic currency that is not backed up by any government. And how do I think about this? I don't think that Bitcoin is a currency, because the currency to me has two main characteristics. The US dollar, the dollar bills that we have in our pockets. The first one is a store of value. If I look at a dollar in the bank today, it's roughly the same value, and I can buy roughly the same thing with that tomorrow. So in that respect, Bitcoin is not. The value fluctuates wildly. So it's not really a store of value. And by the way, it goes up, but also goes down. But the second thing is, it is something that is widely accepted. Now, I can take my dollar bill and go get a coffee, and I can go buy some things at Kmart and Target and whatever. But the thing is that Bitcoin doesn't really have that. It's supposed to, but it's not really having that. So it's not really a currency. It has become much more of it captured people's imagination. So how do I think about Bitcoin? I think more of, if you want a substitute for a trip to Vegas during the pandemic, that might be it. But I wouldn't look at it as saying that that's an investment that's worth considering as an investment. Because when you look at a stock, you're going to get paid, part of the profits that the company makes. So the company has, products and people and makes money, and you take part in that. So there's a productive feature to an asset, to stocks. Bonds, in the contract it spells you what are you going to get paid, so the value is derived from the payments that you'll get. So both of these are productive assets. A farm, a building that you buy to collect rent, they all have a cash flow that comes to you. The only reason that Bitcoin has value is because other people believe that it might have value. But if you're really going to not tie it to anything productive, but just people's beliefs, well, that's more of a definition of speculation. So I think it's more of a speculative aspect to it. And in that respect, you have to figure out, why do you want to hold Bitcoin? Is it because it's on the news and everybody talks about it and you're afraid you're missing out something? And also the logistics of it, I found it remarkable. I know people who have lost the passwords, and they might actually have millions in Bitcoin, and they've tried their password. You only have 10 tries. Some of them have tried it 7 or 8 times and didn't work out, and they're just panicked because if they have 2 more missed tries, it's not like the bank, you call them and they give you the password. That money is gone forever. So I'm not a big fan. I think if you really want to play the game just so you feel like you're engaged and it's stimulating your brain muscle, do it with some sandbox money. That's kind of my view on Bitcoin. I don't think it should be part of a portfolio. More entertainment. And secondly, the question was about the government spending and all this. The thing with government spending is we ran into a situation that's a 1 in 100 year event. That's what last time we had it was the Spanish flu about 100 years ago. So it's certainly going to require some financial effort. I think the incredibly good news that is reflected today in bonds is that the interest rates that we talked about are incredibly low. And why does it matter? Is because if you think of how much did the government pay to service the debt, in other words, pay the interest on the debt, it is a lot less today. Even with a much bigger pile of money that we owe, we spend less on our debt today than we did 10, 20, 30 years ago because the interest rates back then were a lot greater. So we didn't owe as much, but we had to pay a high interest rate. The interest rate right now being so low, it's an incredible bonus. And that's why when you look at the market, people are feeling comfortable with the ability of the government to repay because the interest rates are so low. So when you measure the interest relative to the overall economy or the tax base in many of these ratios, it looks a lot better today, even as we borrow more than in the past. So certainly what the market's telling you by keeping these interest rates very low is that we have confidence that the government can repay it. If the interest rates are going up, if you see the government interest rate going up, that might be a signal that tells you, wait a second, I think you're borrowing too much. I'm not sure you can repay it. And the markets are paying attention to this every single second. And the message that we're getting right now from the market is that there is confidence that the U.S. government can repay its debt.
All right, fantastic. So we are 2 minutes over time, so I do want to wrap us up. Thank you so much for joining us today, and a special thank you to David and Apollo for their time and expertise. Please do just take a couple of moments to fill out a brief survey that's going to pop up. It'll help us improve our service to you. With that said, have a great day, everyone. We'll catch you next time.